Okay, this is Order Flow Trading Course Lesson number 9, Why the Point of Control is Significant. My name is Michael Valtos. I'm the founder of orderflows.com. Briefly, I'll go through a quick disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. See OFTC Rules 4.41. Hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, so let's get started on lesson number 9, understanding the POC, the point of control. Point of control, POC, in a bar is often referred to as COT, commitment of traders. And what it is, it's the price level in a bar where the most volume traded. And most order flow software will put a box around it. So as you can see in this chart here, where the arrows are pointing, there's a box around. That's the price level in the bar where the most volume had occurred. So why is the POC important? Well, it shows you the exact price in the bar where volume was heaviest, which is important because this level can act as support or resistance in the next bar. Imagine knowing where support or resistance will be in the next bar before the next bar starts. That's quite valuable information. Only an order flows chart will give that information to you. If you're looking at a normal bar chart, you're not going to see any information as to where in the next bar price may come down to and react. So in the point of control, it matters because it can show you areas where demand has overwhelmed supply or vice versa. It's going to be the area where the heavy volume was in the bar more often than not. When point of control occurs in the middle of the bar, it can be viewed as neutral, as that is where it should normally appear. In most bars, it's going to appear in the center of the bar. When point of control occurs near the high or the low, it can often signal a reversal. It's an area where the heavy volume was in the bar, and why did the market turn around there? Those are questions you should be asking of the market when you're analyzing it. So point of control near the bottom of the bar indicates that there's usually strong passive buying, which is often strong enough to turn the market, at least temporarily. Think of it as stopping volume. So you can see down here in this, at the bottom, this first bar here at 737, you have point of control right at the bottom. That's where the heaviest volume was. The market couldn't get past it. The market rallied and, came back down, came near it and, rallied back up. But, it's appearing down here at the bottom, and that's a sign that there was heavy volume down there transacting to support the market. Point of control near the top of a bar indicates that there's usually strong passive selling in the form of offers working in the market. It's often strong enough to turn the market, at least temporarily. Think of it, again, as stopping volume. So here, you see this bar at 719, you have the point of control right at the top. In this case, you have a ratio, but it's indicating stopping volume. But think about what's happening. Okay, the market earlier, the high was at the same level. Point of control was just off that high. We made a run back up at the high, and there's heavy volume up there. The market couldn't get past that. Level, and it's acting as resistance, and and subsequently the market sold off. Okay, so let's look at it more in a broader picture here. So the market is working its way down, and it hits this level down here, this low here. We'll call it 29.32. Point of control right near the bottom. of the bar. It's not on the bottom. It's just a level right off the low, which is fine. You're not always going to get it right on the bottom. When you get it, right off the low by a tick, and you got very small volume and a small print here, it's still quite valuable, and it's still a significant level. And, you decide, okay, this is going to be the low. You start moving higher, and what happens? I had talked earlier about using point of control as, support or resistance in the next bar. And you have to take it in context, if you think the market is going to be moving, in a trend. So if you're assuming this is the low, you're willing to, stick your neck out and say this is the low. What happens? Your point of control is going to be your support in this case if you think the market's going to rally. You see the market came down to this level, right where the point of control was. Okay, you have point of control now at this level. The next bar came within a tick of it. And, it formed its point of control in the middle area again. And we came down within a tick of it again. Okay, now we're starting, we're moving, and it's acting as, the point of controls are acting as support on the move up. Here you have the point of control right at this level of 29.42. The market came right to that level, 29.42, and then continued moving up. Again, we got this down bar in there. That's fine. You're going to have down bars in an up move. But you're still looking at the point of control as your support. In this case, you have the point of control here at 29.43. But it's sort of on the back of this 29.42. Support and resistance is, usually not one particular price. It's more of a level, a zone, so to speak. We came back down to this point of control, 29.43, 29.42 right here, and continued up. If someone were to pull you aside and say, hey, I could teach you how to find support or resistance in the next bar based on the bar we're in, you'll think the guy is trying to sell you magic beans like in Jack and the Beanstalk. You're correct. But, that's what point of control can do for you. It can act as support or resistance in a market that's trending. Okay, so let's talk real quick about this. In this case, you sort of got a bunch of different things going on. You got point of control here, right at the high. It's indicating, some sort of stopping volume. Again, you have it here at the low. Again, it's acting as stopping volume. I'm willing to take it in the last, either the top two or the bottom two. If it's a green bar, the bottom two. If it's red bar, the top two. I find it's a little bit more powerful when it appears right on the top. But, sometimes it's really difficult to get them on the top. And, if I'm assuming the market's going to be selling off as this, I'm going to use this as my my resistance level. Here, I expect the market to stay below it. Then the next bar, the resistance will be here. We're staying below it. If I think the market is turning here, it's going to be my new support level. My support level here. This will be my new resistance level. Take it in context like that. And you can see how it occurs in the market on a regular basis. Now, when the point of control is around the middle of the bar, it should be treated as normal. That's because that's where it should be. Think of a normal distribution. Please note, I trade based on range charts, where the bar is formed as the market moves from price to price as opposed to forming a new bar when the clock takes 5 minutes or whatever. I prefer range charts over minute charts. It's a personal choice. I know traders that use minute charts and are quite successful. I prefer range charts personally because I like to see how market moves from one price level to the next price level. Now, in a sideways market, you often see point of control around the same levels for several consecutive bars. It doesn't necessarily have to be one particular level. Here you have two at the same level, and then you have two, just right below it. To me, it's often a sign, when you throw it in with, bars that are opposing in the sense of, you got green, then red, then green, then red, then green, then red, and you're getting point of controls lining up. It's just telling me the market's going sideways. It's a very visual and quick thing to see. In a trending market, point of control becomes the support or resistance of the next bar. You can see here, right, the market is starting to move up, and you're going to take the point of controls as your support on the move. If you're saying this is the low, and watch where price retraces right back. It retraces right back to that point of control, and then makes its move higher. If here you start looking at 1892. This bar, this was where the point of control. We pulled right back into that in the following bar. Then you have the point of control at 1894. We pulled back into it. Got through it by a couple points. That's fine. It's not the end of the world. The market's continuing higher. This bar at 1896 did come down to 94, but it's still holding as support. Now we have it at 1896. Yeah, we pulled right down to that level and continued back up. I had talked earlier about saying, if point of control is in the middle of the bar, that's neutral. Well, what I mean by that is point of control generally will form in the middle of the bar. But that's fine if it does, and we're in a move, that's where your support or your resistance is going to be. When I talk about appearing on the edges of the bar, it's, important in the sense that that's where the market can turn. Okay, so let's take a look here at what's going on in this market. This is the 5 years. So you have the point of control right at the bottom. This bar at 6 o'clock. You got the big selling imbalance right on the bottom. You got a ratio that you like. You're going to say, okay, this is my low for the move. You're expecting to move higher. Where can you buy? Well, you want to look at some area of support to buy around, if possible. Okay, well in this case, the next bar, it's a down candle, so I don't know, you can buy anywhere in that bar and be happy. Say you're ultra conservative, you want to try and get in around the point of control, you can. It came right down to that point of control. Usually I like to get in around, maybe a tick or two higher than the point of control. Just because I know that sometimes the market doesn't come back all the way to the point of control. So even if you get a tick up off of this point of control or two, you're still in it. Now, this bar, your point of control is here. We came down within a tick of it. Point of control is now here at 18. We came down within a tick of it. Point of control is here at 19. We came down exactly to 19. Now your point of control is 19 and a half. Yeah, we came down to 20. Here it's at 20 and 3/4. We came down to 21. And it's just, stair stepping up, but you're using your point of controls as support. If you want, you can trail your stops to those point of controls or, areas around those point of controls as your stop price. Okay, so, here's a 5 year, but this time it's going down as opposed to going up. Earlier was an example of it going up. And, what's happened? Okay, you hit the high, you zoom in. If you're thinking, there's a shift in supply and demand and the market's going to start selling, you may not think it right here, but, definitely in this bar, you really change your idea by this bar for sure. And where's your resistance levels? Okay, it's going to be here, this point of control at 01 and a half. We came up to 01 and 3/4. We came up to 1 and a half. Now it's 1 1/4. We came up to 00.5. Here's your new resistance level at 00.25. We came right back up to it at 00. And it's just acting as your resistance on the way down. Okay, now, crude is a market. It moves very fast, relative to the 5 years. 5 years can be a very quiet market to trade, and it's, sometimes quiet markets, just don't appeal to people. People tend to like active markets that are moving fast. It's your own personal taste, but, the same concepts are applying. Now, I won't talk about this move up, but, what happens, you have this move up, and we sort of go sideways, and market starts to head down. You got this selling imbalance, so it's telling you, hey, the market couldn't continue up. Now it's starting to sell off. You should be thinking about getting short. And where's you have the selling imbalance already? Okay, so you got the point of control right here. We came up within a few ticks of it and turned around and headed south. Now your point of control is here at 33.50. We got up to 47 and turned down. Here your point of control is at whatever this is, 43. Yeah, we got up through it a little bit and then we continued down. It's acting as your resistance on the move down. That's an example in crude, which is a much faster moving market than 5 years. Again, here's a crude chart. Again, we're moving up, and point of control is acting as your support on the move up. You have this change here in supply and demand, and now on the way down, your point of control is acting as resistance. You're getting through it by 2 ticks, 3 ticks, which is fine. When you're trying to get short on a pullback or get long on a pullback, sometimes the market overshoots it by a couple of ticks, 3 ticks, sometimes 4 ticks. I mean, that's just the nature of the market. It doesn't always turn right at the level that you want it to. I mean, in the best of all worlds, yes. But the problem, sometimes it doesn't give you that chance, and you miss your entry, and then the market just continues in in a direction that it should be headed. Okay, now let's look at a E-mini chart. It's the same thing. Here's your point of control. You're assuming the market's in a move down. You got your point of control right here. We're staying below it. You come right back up to the point of control in the next bar and sell off. Now you got the single print right at that point of control. It's telling you, hey, there's no more follow through. Now your point of control in this bar, you get up within a tick of it. You just get past of it by a tick rather, and sell off. Point of control's right here. Get up to within, 1 tick and sell off. Here again, we get up to within 1 tick and are going lower. It's something you can, trade around or, place your stop around, if you like to trail your stop. Okay, again, this is a Euro stock. It's a stock index. And, you're taking, you get up to this level, you got a single print, a ratio bounds low here with some stopping volume. It's a weak one, but, it's stopping volume nevertheless. It's giving you a ratio. But you got three ratios, and, it's telling you, hey, the market isn't getting the follow through that, you're expecting. So, look to get short. And, if you're looking to get short, you're using the point of controls as going to be your resistance levels. So, if you're not short in this bar, looking to get short in this bar, it comes up within a tick. Here it comes up back within a tick. Here it comes up within a tick. Here it goes right back to a tick. So you have chances to get short in there. Okay, just real quick, here's the bond chart. Same thing, on the way up and on the way down. We're working our way up, You got the buying imbalances. It's not really meeting much resistance. Then you get up here, and, what happens? You get a buying imbalance here, a selling imbalance, and right at the bar, you're seeing a shift in supply and demand happen right up here at the high. You get the early buying imbalance, then, late in the bar, you get, selling in there, you get a big negative delta right at the high. It's telling you, hey, the market's, primed to start to sell off. Okay, so, you want to get in, and, where are you going to be looking to place your stop? If you're getting in, early in the next bar, you're going to have a stop up here at the point of control, and, you're going to be looking at the point of control as your resistance on the move down. If you want to trail your stop, you can trail your stop around the point of controls. The market is staying below the point of controls. It doesn't really, in this case, the market dropped pretty quick, and, there really wasn't any much retracement back into the point of controls. And, lastly, this is a bond chart. Early on, it really looked like we're going sideways. You get a red bar, a green bar, a red bar, a green bar, and you're getting the point of controls, around the same levels. You got 3 in a row here. Even to a lesser extent, you draw it out here, you got, point of control at the same level. Here it's a little bit higher. It's tricky when it's like this. It's in a range because, you want to take it as support, especially when you're seeing, you're all just spending a lot of time above it, but, it could go below it pretty quick. This is a case where your support can, also become your resistance if you break the, the support level. When it's strung out like this, I find that oftentimes, when it breaks through in the opposite direction, like here, I'm inclined to think it's, a support level because, you have the imbalances here early, and we're sort of holding it later. I don't remember what the rest of this chart looked like if we rallied or sold off. But I tend to find when we're spending, this time, more time above this support level, that if we start to come out of it and sell off, it's going to become resistance very fast. And oftentimes I find once it starts to sell off, it can sell off pretty quick. Okay, so that's the end of lesson 9, pointing controls. In the next lesson, I will explain the importance of delta and how to interpret it. Delta is something that's extremely unique to order flows that you're not going to find on normal charts, normal bar charts, normal candlestick charts. And it's very powerful, especially if you can sort of mesh it in with a couple other analysis, like pointing controls. And it's something that is once you understand delta, it's going to really make your trading much better and more powerful. So that's the end of lesson 9. Thank you, and I'll see you in lesson 10.